Hello, greetings, and welcome to Dividend Blasters. This is our 16th video for the channel. The purpose of this video is a follow-on of the previous video. And recall that videos 14 and 15, we're talking about debt reduction while being a dividend growth investor. So in 14, I identified 3 pretty good online tools that are free to give you insight into the duration and the cost of reducing personal debt. And I think that for dividend growth investors, that's important because we don't have unlimited resources. We do need to make decisions around how we're going to allocate our dollars. Are we going to invest? Are we going to pay down our debt? Is it going to be some combination? What is that mix? And then in video 15, I generated 5 scenarios that showed some of those mixes. The first mix really was the baseline, essentially, was paying the minimum down on a $100,000 credit card balance, and what the cost would be and what the duration would be. And then being able to invest in our dividend growth stocks and ETFs that I laid out in the model. And then I went through 4 more scenarios, 2 through 5, showing increasing debt reduction and decreasing investment and what the impact is on paying down the debt. What I didn't do, and I'm going to do now, and this is really an add-on here in video 16, is show what the impact is of deferring 100% of our dividend growth investing until the balance is paid off. So that's what I'm going to show you here, and I'm going to move right along. But before I do that, quick disclaimer, I am not a financial advisor. The purpose of this video is for information and education. It reflects my own opinions and my own experience. Please do your own research. Consult a financial advisor prior to making any financial decisions. And then finally, before we move on to the expanded model, I would ask that if you like these videos, please give us a like and subscribe to this channel. It would be of great help to the channel, and share the video with a friend or a family member if you think they'd benefit from it. All right, we're going to go ahead and pivot to the model. Okay, so pivoting to the expanded model, you've seen this before now in video 15. What I did here was I added a new scenario. So video 16, what is different here? Well, the debt reduction payment has increased. So recall that in video 5, scenario 5, excuse me, that was the most aggressive scenario in the last video. We were basically paying out $3,000 a month, or about almost 38% of our income, to pay down the debt. Okay, and that was $1,000 a month above the $2,000 minimum. All right, and we were investing $1,450 a month almost. So here in scenario 6, we're actually upping it. Instead of 3,000, we're actually going to devote 4,450 per month, which is $2,450 above the minimum payment. And when we do that, we can't invest anything until we pay it off. At least that's our choice in scenario 6. So in scenario 5, we were paying about 18% in investing, in our stocks and ETF. Here in scenario 6, we're not paying anything. We're actually going to focus solely on debt reduction, debt elimination. Let me say that. The first 5 scenarios were debt reduction at a slower pace. This is a more accelerated pace. It's debt reduction, but it's really focused on elimination in a shorter term. And what we see here is that in scenario 5, we were able to pay off the entire $100,000 balance with interest in about 4.5 years. In scenario 6, when we are deferring all of our investing activities, we can pay it off in 2.5 years. Why can we do that? Well, we're putting more money down and we're reducing the principal quicker, and there is less time and less opportunity for the credit card company to tack on interest. Remember, that is their dividend snowball, and Mr. Ramsey refers to it as the debt snowball, which is really quite brilliant in my judgment. He's right. I'm going to call it a dividend snowball. We are their snow, if you will. And the way to not be their snow is to not get behind and carry these debt loads for a significant period of time. Now, if you scroll down a little, I have the breakout by principal, by interest, and total. So I didn't show this in the first or in video 15, but I always had it there. In scenario 1, we were going to pay $345,000 total, which was about $245,000 in interest, and then the $100,000 principal. Okay, these are all $100,000 principal. The only thing that's different, which varies, is the duration and the interest payment. And as the duration increases, the interest payment increases. And as the interest payment increases, the total payment increases. So looking at scenario 1, we actually see where we're just paying the minimum. It takes 14.4 years. We are paying $345,000 total in return for a $100,000 balance, if you will. And we did go through this in the previous video. It goes down to 228 in scenario 2, 198 in scenario 3, 173 in scenario 4, 161 in scenario 5. Now, when we take the most aggressive stance, when we are very hawkish about eliminating our debt, we actually make market progress. We will get to debt freedom on this loan or this credit card balance or balances in 2.5 years. So we're paying back the $100,000. The total interest accrued is going to be $32,000. And then the total paid back is $132,000. So when you compare scenario 1 and scenario 6, it's significant. It is absolutely stark. And if you're in a position, and not everyone is, I recognize that, but if you're in a position to accelerate your debt elimination strategy, I would say go ahead and do it. But that's just my suggestion. This has to be your decision based on your resources, your income, your time frame, your appetite for investment. A whole bunch of things go into this. I have a couple charts, and this really highlights, if you will, the difference graphically in interest from scenario 1 down to scenario 6. That is significant. That is about a factor of 8. That is huge. If you think about it this way, think about $212,000 saved that you can invest in dividend growth investments 2.5 years from now. Okay, that's cost savings, if you will. And here is another graphic that really shows the component pieces of the payments by scenario. So here's scenario 1. Here's your 345. I only added labels to the interest because that's really what's driving this. So 245 down to 128, down to 98, down to 73, down to 61, down to 32. Okay, that's really what it is. And you'll see that the gray is the total payment amount. That's coming down. So as the interest comes down, the payment comes down. What stays the same is the principal. It's $100K no matter what. And here's our last graphic here on the summary tab. This shows a breakout of each scenario's duration, where we're basically paying off the minimum. For scenario 1, it's taking us 14.4 years. Scenario 2, we're cutting off about 6 years. It gets down to 8.5. Scenario 3, we cut off another 1.7 years. It gets down to 6.8. Scenario 4, we cut off another year and a half. It gets down to 5.3. Scenario 5, we cut off about 2/3 of a year. That gets us down to 4.5 years. And then scenario 6, which is really quite stark, you cut down another 2 years and you're done in 2.5 years. So that's what this looks like graphically. And the purpose of this tab was to give you a comparative view of the 6 scenarios. And specifically, I wanted to show here in this video what the difference is, the impact of focusing solely on debt elimination, if you can do that, and deferring investment activities. Something I'm not happy with. I love to invest, and I love to invest a lot, but when I look at that interest and the difference, it really puts it into context. Let's take a look at the new tab, Scenario 6. So income stays the same. It's still $8,000. Monthly expenses are the same. And again, these will change for you based on your own situation. This is what changes right here. The optional line item. So above and beyond the $2,000, we are increasing that monthly payment by another 30%. So we were doing 25% of our budget. We're adding another 30, almost 31%. And this is really what was initially in scenario 1, what we were using to invest in. Now we're not investing until we pay off the loan. So here's $2,450 we're throwing in there to liquidate that debt, if you will. And we're doing it every single month. And as we go through here and look at row 23, you'll see it decreasing. And in fact, take a look at the balance. It actually gets down about $2,500 in that first month because recall that the interest is $1,925 in that first month, but we are throwing down the gauntlet that first month. We're paying $4,450. So that is killing their interest, which is high, but it's bringing it down about $2,500, if you will. And we keep doing that. So anyway, let's just scroll down here and we'll see where it ends. And you'll see when you look at this tab compared to the others we went through, it ends much quicker. And in the last month, we're actually paying less. We're not paying $2,450. We're paying $31. How much are we paying? We're paying $31.67. We're paying the $2,000 and the $1,228 plus the interest, and that gets us. And remember that you are still accruing interest every single month as you pay it out. So that will get you to zero, if you will. Here is the $132,000 total payments that you're paying back, and then here's the $32,000 in interest. And the delta there is, you guessed it, it's $100,000 in principal. And then when you go down here, you'll notice that the investment section is empty. Okay, we are not investing anything until we pay off our debt. Now, you know what? I'm not saying that this is the approach. I'm just saying that this is a approach. So you can get additional context and you can get a sense of, hey, maybe you might say to yourself, you know what? I don't want to defer all my investing. I do want to pay down the debt at an accelerated level, but I want to leave a little bit there. And so, you know what? Here is a framework for you to look at and to leverage in making that decision. And that's really what this is. This is really to help you make a decision on how you want to go ahead. If you're faced with debt, carrying debt levels that are a little bit problematic, this is how you might approach this. This is how I would approach this if I were in that situation. So anyway, I wanted to share that with you. I hope that you found this useful and educational and informative. And if you have, I would kindly ask, hey, please give the video a like and subscribe to our channel. It's a great help to us, and we greatly appreciate your time. And also share the video with a friend or a family member if you think they will find it useful. And I'd love to hear comments. If you have any ideas or suggestions, or if you think I missed something, add a comment on the site or shoot me an email. All right. Thanks all, everyone. Have a wonderful day. God bless.